how hard it is to find a property, and it's easier to just find a good operator to place your capital with that's going to go out and do all that heavy lifting on your behalf.
Yeah, April of 2016, I closed on my first single family, did the whole BRRRR method. I had about $20,000 to my name at the time saved, but I found a house cheap enough for $88,000 where I was able to put 20% down, just get by on the closing costs. Had my first house, so we figured it out, which allowed me to buy a 3-unit about 12 months later.
Welcome back to another episode of the Peak Profits podcast. Today, we are joined by Will Harvey, founder and principal of Harvey Capital, a real estate investment firm focused on both active and passive strategies across public and private markets. Will operates across multiple verticals, including hard money lending, house flipping, hospitality assets, multifamily investing, and seller finance note acquisitions. He also specializes in identifying valuation disconnects between public, private market real estate markets, uncovering opportunities many investors would typically overlook. Will, we really appreciate you joining the podcast. It's great to have you. How are you?
I'm good. Appreciate you guys having me on and grateful to be here.
Absolutely. Your background, Will, is somewhat similar to Brian's, where you started with a number of kind of single family investments, followed by a number of multifamily investments directly as a passive investor. So if you could bring us all the way back to kind of the beginning of your journey in real estate and talk us through kind of those first few steps, how you got into investing in real estate, how you got into investing passively and actively, that'd be a huge help.
Yeah, absolutely. So a little over a decade ago, in late 2015, I got into the mortgage business. I dropped out of school and I was going to finish up at a local college. I was playing football and just got hurt and decided that was a wrap on that. So came home and didn't really want to continue with school. I had to be there for a while because a lot of my credits didn't transfer. So I ended up getting into the mortgage business, and I wasn't really, I never really wanted to get into real estate. It wasn't like I was trying to do that, but I got in the mortgage business. And after a while, I just realized that, hey, it's not rocket surgery, as they say, to buy a house. And there's a lot of programs out there. So I bought my first house about, 6 or 8 months after being in the business. I had my father co-sign. I wasn't making a ton of money at the time, but figured out that I could have him co-sign, and then I could buy this house. And I knew what it was, a 3-bedroom townhouse. I knew what each room would rent for. So I lived in one room, and then I had my brother rent from me in one of the rooms. And then I had a tenant that we just brought in with us. He rented the third room. So it was kind of a house hack without me even knowing what a house hack was. And so that's what I was doing. I was then I started making more money in the mortgage business and bought a couple more houses in the Northern Virginia area, and just realized that, one, I'm running out of money. If I'm just using my own money, I would buy a house and boom, I'd be out of money. So then I would just have to wait until I have enough to do it again. So that was one issue. The other issue was I realized that I did not like tenants. I did not like everything that came along with having tenants and toilets and all that fun stuff. So I gravitated towards the multifamily syndication side of things. That was, I started doing that passively. I left the mortgage business, and after doing that for a few years, it was an awesome ride, made good money. And then I just wanted to do my own thing. I was tired of working for a rigid, lending institution that I was more of a rogue operator and liked doing my own thing. So me and a partner started a house flipping company, and I would use the profits from that to invest in apartment buildings passively. And, it was really good for tax purposes with depreciation because I was considered a full-time real estate investor. So I could offset my earned income. And, was doing that a while, and I just slowly gravitated more and more to the finance side of things. There's a couple real estate ventures I led, like a wedding venue. We still own that. A little boutique hotel that me and a partner still own. But after that, I started a fund in 2023, and pretty much since then, I've been more on the finance side of things. And now my focus is on buying notes, so seller finance notes. There's about 20 states that we market to, and just recently started doing that. I've only bought a couple, but that's been good so far. And then I also have a company, and we do hard money. So we do hard money loans for real estate investors primarily in the Virginia area. So I know that was a lot to unpack, and kind of the evolution started out as a single family, was trying to get to 100 houses, and got to 3 and realized that tenants are not for me, and just slowly got to the finance side of things.
As Chris mentioned earlier, it does sound a lot like my journey. What year was that you bought your first house? I'm not sure I caught that.
2016.
Same as that for me. Yeah, April of 2016. I closed on my first single family, did the whole BRRRR method. I had about $20,000 to my name at the time saved, so not much coming out of college, but I found a house cheap enough for $88,000 where I was able to put 20% down, just get by on the closing costs. And again, was broke, like you mentioned, right after that. But hey, I had my first house, so exactly. We figured it out. And I opened up a Lowe's credit card to start to fund some of that construction and upgrades. But luckily, my dad's in the industry, in the construction industry. So we did a lot of that sweat equity ourselves over the course of 10 months. And so it kept a lot of that extra spend in my pocket. I was able to finance what those upgrades would have been. So that turned out to be a positive. Cash out refinanced, was able to pull about $40,000 out, which allowed me to buy a 3-unit about 12 months later. And so similar story, after I had, multiple tenants, units under my belt, I was like, hey, how can I scale this more and maybe not become a landlord and just buy single family houses, each and every time. And so it resonates with me, your story. And so, digging into kind of your progression as well as your growth, because now it seems like you've gotten into a lot of different real estate verticals throughout, the last decade. And so what you guys are doing today from a hard money lending side, sounds like that's kind of where you're migrating to primarily on the finance aspect of things. Why do you feel like you've migrated there? What do you like about that aspect of growing the fund?
I like the hard money side because, and to be clear, I have 2 funds. One is we do, it's closed now, but we do, there's just a kind of a hodgepodge of stuff we do in that, including, investing in some public real estate companies as well as hard money. But now the fund that I started about 6 months ago is dedicated solely to hard money. And that's what a lot of my time goes towards now. And you asked.
So I guess with that fund that you started 6 months ago, let's dig into that a little bit. Are you raising from family, friends, accredited investors, or both, non-accredited as well? And then are you pulling that money into an SPV or some type of fund structure entity, and then you're finding opportunities that you can lend that out to for fix and flippers?
That's exactly right. So we operate as a limited partnership. So that's the fund is a limited partnership. And then my company that I own 100% is the general partner of that. And we just have a simple split between the LPs and the GP. There's no fees or anything like that. It's just a profit split. So and yeah, you hit the nail on the head. We're trying to find good borrowers and good deals that we want to back in first lien position only. And it's a lot of fun. I like it because it's you can kind of live vicariously through the people that are buying and flipping these properties. A lot of them are actually buying, and they use our money for the short term when they buy it, and then they fix it up and refinance it into like a DSCR loan or something like that. So we can, I can live vicariously and see these cool projects get done, but without me having to do anything and deal with contractors and, all that, all that stuff. I'm more of I like being in spreadsheets. I like that kind of stuff. I don't like swinging hammers. I don't like, messing with.
Can you talk on that note, just on the structure of loans that you've lent out so far and your process of what terms look like for a borrower? Percentage that you're charging or
yeah,
points?
Sure. So yeah. Great question. So our standard product is that I do is a 9-month term. So they have 9 months, and we have some built-in extensions that, people can pay for if they need more than 9 months, but it's a 9-month term, and we charge a flat $700 doc prep fee, 3% origination fee. So that's 3% of the loan amount. And then the interest rate is 12%. So to somebody who's never gotten hard money and doesn't know how it works, that sounds outrageous. But it's very standard, if not on the cheaper side, especially where I am. I see some guys that are charging 4 points and higher interest rates. So, it's actually pretty reasonable. And the guys that are borrowing from us are, they're not in this product long term. So they're only in it for 3, 4, 5, 6 months. So they're not paying a ton of money in terms of the interest, because they just simply don't have it that long. And for us, what benefits our investors is the name of the game with hard money is turning the capital as fast as you can. So when you're collecting those points up front, the faster that we can do a loan and then get paid back, the more that we can go out and lend again and charge more points, and that increases our annualized return. So we do that. We try to work with borrowers who are quick, who get in and get out of their projects fast. And then we've actually sold some loans recently and sold partials where we sell 50% of a loan, where, we keep all the points, but there's some note buyers out there who will buy the note. And we actually also get to keep a small servicing fee as well. We service it, so nothing changes for our borrower. And that allows us to, again, boost our annualized return, because we can do the loan, collect the points, and then, sell half of it and then go out and lend that money out again and collect more points. And so recycling capital quickly is the name of the game with hard money.
Can you talk us through like an LP's, like what's the minimum investment? Like what are their expected annual returns on throughout your fund? Like, can you give us a little bit more context on that?
Yeah, absolutely. So the stated returns that we're trying to hit are 10 to 15%. So we're trying to hit that on an annualized basis for our LPs, and that's net of the general partner split. So again, we have a simple split that's 82% of all profits go to the limited partners, and then 18% goes to the general partner with we have no AUM fees or any of those silent killers that eat into the returns. So that's 10 to 15% is what we target. We pay out all net earnings on a monthly basis, and that's our goal, and we've been exceeding that thus far. But that's what we're trying to do.
Sounds like a simple structure that's easy to understand for investors coming in. Is there any preferred return, or is it whatever you're making in that month, you're just splitting that 80-18, and then you're paying it back forward and you're keeping it simple?
That's it. I have a philosophy. I've seen it firsthand in deals that I've been in as an LP, and then also deals that I've been in as a GP. Where, and this more pertains to real estate, but I think that a preferred return can sometimes, um, cause the interests between the LPs and the GP to diverge. Um, I'll give you an example. We have this boutique hotel um, that we bought about almost 4 years ago, and we've been paying. We've been paying the investors their preferred return over time, but there hasn't been enough to get into the split. There's been a lot of forced appreciation, and when we sell it, there should be a lot on the back end that is realized, in terms of capital gain when it's sold. But me and my partner, who are the GP, we have not made a penny on it so far. So naturally, that can cause us to want to sell it, whereas the LPs they're like, great, let's just keep this thing forever. We're making our money, and this is wonderful. So I just have seen other people talk about that. I've seen it in my own deals, and I just think a simple structure where everyone's interests are aligned and we're all rowing in the same direction. I think that is, that just makes the most sense
Definitely.
to me.
Yeah. And I can get behind that and agree with that as well. I think in the sense, to your perspective, like if it's an 8% preferred return and you're cash flowing maybe 6 or 7% during the whole period, right? There's no aligned incentives unless you're taking some type of property management fee or asset management fee, which again will eat into potential profits or cash flow for your LP. So if you're just splitting it up front, then you're still making percentage profit each month, but you're distributing majority of that to your limited partner.
Yeah, exactly.
Now, from your structure standpoint, do you have a portal for your limited partners, or how do they invest and choose to invest through you? And is there any minimum investment to join kind of your fund, and what does that look like?
Yeah, the stated minimum is 100,000, but we've been flexible on that. And for people that want to start out lower, we're fine with that. The fund's open throughout the year, so I have some guys that are like, let me. They've never worked with me before, and they want to start out a little bit lower and just see how things go, and they want to increase their allocation over time. That's totally fine. And yes, we do have a portal. We white label a portal from this company that is awesome. They're called Lender, Lendr. And it was this hard money guy, Bryce Matheson. He was doing hard money, and he realized that there wasn't really a solution for guys that are going out and raising money and have investors, and also for managing all the borrowers and paperwork and all that stuff. So he has a tech background, and he created this awesome portal. And I just can't speak highly enough about it. So yeah, we have a great portal that handles e-signing and all the documents and all that stuff.
How do you go about originating the loans? Like, how do you identify those people that need the loans? Like, what due diligence do you do on the people that are ultimately borrowing? Like, can you talk a little bit through that process so we can understand like your structure really of how you get to sending those loans or agreeing those loans?
Yeah, absolutely. So when I first started doing hard money, it was really just, kind of an accidental business where I started this real estate fund. We never really intended to invest in hard money loans, but we had capital sitting on the sidelines, and I had some guys that I knew just in my network call me, and I knew them very well. So it was easy to, I knew how they operated. I knew they weren't fraudsters or anything like that. So that was easy, but obviously that's not scalable. So now what I do is I've really been incorporating AI into our flow recently. There's a lot of the standard stuff, collecting your entity docs and driver's license just to make sure people actually exist and aren't trying to scam us or anything like that. The biggest thing that I think that a lot of hard money lenders focus too much on is the asset. So we put a ton of emphasis on the asset, but I don't think enough emphasis is put on the borrower. I will hear people talk about how, they'll do credit scores in the 500s. I would never in a million years loan money to someone with a credit score in the 500s, just because that's probably unless they had some kind of life circumstance, some kind of crazy life event that happened. That's a very good indicator of their their character and their ability to repay. And if things go sideways on a deal, I'm gonna bet that someone with a 500 credit score is probably not gonna pay. So we're very focused on the deal, but I put a lot of focus on the borrower and their background, their experience. Are they talking to me about the deal, and does it make sense? Is it coherent? Is it, or are they, can I tell by what they're saying that they don't really know what they're doing, or they're just trying to wing it? There's a lot of tells when you sit down. I really try to, especially with doing this locally in the Richmond area, I try to sit down. Everybody that I've loaned money to so far, I've met face to face for at least a lunch, if not multiple lunches. So, I'm able to see how they tick, how they operate, what they say. Are there any red flags that they're talking about? And kind of put on my underwriting hat and feel that out. And then, if that passes the smell test and it seems like they have experience and they have good reserves in the bank and they're a serious investor, then it just comes down to the deal. We lend up to about 70% of the ARV, of the after repaired value. So we'll go up to 70%, and it's my ARV. It's not the borrower's ARV that they come up with. So I'm the one that is figuring out what I think the ARV is.
Significant difference,
basing
I'm
it on that. Yeah, exactly. Yeah, it can be. But if you're working with good borrowers, then, they're going to be conservative on their ARVs too. So, I really want to work with good people that have experience and, are doing good deals and aren't just trying to fly by the seat of their pants and do every deal that comes their way, because that's how you get into trouble.
Yeah. And that sounds like more of a instinctual and gut feeling once you meet someone and being in the industry for 10 years, like understanding their knowledge base, how they speak about their business, what their business plan is for this property, and ultimately how quickly they can complete that and recycle your capital or get that loan paid back off. Because at the end of the day, if you're borrowing money at 12%, you want to pay it off as quick as possible too. And you want to complete that project, right? Because it becomes expensive. And so it sounds like you have a nice system in place, and you have the experience of going through it as well, which gives you, right, that lens of their business and understanding how it operates. So when you're underwriting a borrower, what are you asking for them? What's the process of application or applying if you find someone? And like, what docs are you putting together, and how are you putting together these docs to ensure that you're covered and, you have your safety net if something goes sideways?
Yeah. So right off the bat, we're going to want to see their driver's license. We're going to want to see their entity docs. So we only make loans to LLC, or not necessarily just an LLC, but we only lend to entities. And that is what allows us to stay in the commercial lending space, where we're not regulated by, the Dodd-Frank Act and all the stuff that went into place post 2008. So these are strictly business loans for commercial purposes. We don't lend to primary residence borrowers or anything like that. So we want to make sure that that is the case, and that they're not, using this for, to buy a primary residence. So we're collecting all that stuff up front. And then as far as the loan goes, we want to see the purchase contract. We want to make sure everything lines up with what they've told us and what's on the contract. We're gonna make sure that there's insurance. So we're gonna see evidence of insurance. we're going to get a lender's, we're going to get a title commitment from the title insurer. Usually the title companies who handles that, they order the title report, give us insurance on the title of the property. So we need to have that in place. We need to have insurance in place. And then every loan is secured by a first lien deed of trust. So we're in the first lien position. We're the first to, we're the senior creditor in the capital stack. We haven't had any situations where someone does a second behind us. We really don't want that. We want that to be coming from their own funds and not more debt. So we're in first lien position. We have a deed of trust, which secures our interest to the property. And, if they go into default, knock on wood, it hasn't happened yet, but that's probably because we just simply haven't done enough loans. Eventually you're going to run into defaults, you're going to run into foreclosures, and we just want to make sure that we're doing everything to ensure that if and when that happens, we're protected. We have enough equity cushion in the deal where if we have to, go and force a foreclosure sale, that we're protected, or even take a property back ourselves, that we have enough meat on the bone to sell it and at least break even, not realize a loss. And Virginia is a good state when it comes to compared to other states, is a pretty good state when it comes to foreclosures. It's non-judicial, so there's a pretty streamlined process as opposed to judicial states like New York, New Jersey, some of those states where it takes a lot longer to foreclose on someone.
And do you only lend to people in Virginia? Is that the only state you currently operate in?
Right now, yes, just simply because, I have learned from the mistakes of others, and I see guys that venture outside of their markets that they know. Real estate is so localized that, we just don't really have a need right now to venture outside of Virginia. It's a great state when it comes to the laws in place for foreclosures, and so we're protected there if something happens. We know the area. I've lived here my whole life. So that's pretty much where we need to be. It'd be a great problem to have if we outgrow the markets here and need to look outside of the state. But for right now, I don't think it would be wise to do so.
Yeah, I'm sure it definitely would be a good problem to have if you outgrow just an entire state. That would definitely be a good problem to have. So I want to pivot slightly. You mentioned that you actually sometimes sell some notes, but you're also buying notes. So for the listeners who don't understand what buying and selling notes ultimately means, can you kind of give us a 10, 15 second overview of what that actually means in layman's terms, and then kind of talk about how that impacts what you do on your day to day?
Yeah, absolutely. So when you look at a note, it's basically a contractual stream of income, and there is a secondary market where you can buy and sell notes. After the 2008 crash, people were just giving away notes, and all these banks had these non-performing notes, and even performing, that they sold for pennies on the dollar. Over time, that has changed, and now you're not able to get these crazy discounts that you were able to get back 15, even 10 years ago. So where I look to buy these notes, and I should say that this is we do this in the original fund. This is not in the hard money fund. Only does hard money. We sell hard money notes from that fund, but we're not buying any secondary notes out of that fund. But what we do is we send mailers out every month to people who have recently originated a note in a seller finance deal. So that's when they go and sell a property and they carry back a note on it. So the buyer comes and let's say it's just for round numbers, it's $100,000 property. The seller will have them put down $20,000, 20%, and then they'll carry a note for $80,000. And that's how they sell the property. So the title transfers into the buyer's name, but the seller, they hold a note that's secured to that property. So if the person stops paying, they have a path to take it back. But otherwise they're not the owner. They don't have to deal with managing toilets or tenants and any of that stuff. They just collect the monthly payment. So when a lot of sellers will originate these notes and they're not done. They're not done to the standard that a bank or an institutional lender would do, as you can imagine. A lot of these are mom and pop note creators that have never done this. So we have found that there's a pretty you can find mispricings in that area, and people are willing to sell them at a discount if they have a 30-year note that they originated at 8%. They might want to just cash that out. They're not going to get the full note balance. They're going to get it's going to be at a discount that we buy it for. But if it's a decent note, it doesn't have to be a crazy discount, and they get that that cash up front, and we get that return over time, and it works for both sides. So recently started doing that. And then again, on the note selling side, we back to the hard money fund, we will sell notes if we need to, if we're light on funds and we have more opportunities than money, which recently has been the case, which is a good problem to have because we can, cherry pick the best borrowers and the best deals to get involved with. But it's still a problem, and we need to raise funds somehow if we want to do those loans. And one of the ways that we can do that is by selling one of our notes or selling a 50% interest in one of our notes. So it's great for people buying them because a lot of these guys they want that passive income, but they don't want to deal with servicing it. So we want to service it. We want nothing to change for our borrowers. They don't have any clue that we've sold their note. We're not dishonest. If they ever asked, I would certainly tell them. But nothing changes for them. They keep making the payments to us, but then, we will send the payment to the person that bought the note, and just works for everyone. And I'll give you an example of one where we originated a hard money note back in early December. And at the time we were flush with cash, and the guy beat me up a little bit on the rate and points. So we did it lower than we would normally do. We did it at 2 points and 9.5% instead of the regular, 3 points and 12%. And what I ended up doing was there was a guy that I sent him the loans that I was willing to sell. That was obviously one of them, and he wanted it. So he liked the note, he liked the location, and it appealed to him. So he bought the entire thing from us, and it just worked out for everyone. Now we had that capital back in our hands that we could then lend out at higher interest rates and higher points.
That's awesome. So how are you going about servicing the notes if you buy, or one, I guess first part of the question is, how are you finding seller financed notes? I'd imagine there's some data points online that you could find them. And then once you locate a bunch, how do you target to them? It sounds like mailers. Once you get a response to buy them, then how are you servicing it? So really just kind of walk us through that process of identifying, buying, and then servicing those notes.
Sure. Yeah. So with this segment, I haven't been doing it super long, but I'm still happy to share exactly what I've been doing. So there was a guy on this other podcast, and he was talking about how he's been doing this since the early 90s, and he's tested every single thing you can do as far as the color of the mailer that you send, the envelope type, this, that, the other. He tested all that over the years, and there was some podcasts I've listened to. He just laid all that out, and I was like, man, this is gold right here. I knew I wanted to be in that space, and start to market to buy seller finance notes, but I just didn't know where to start and what to do, and that just shortened the learning curve tremendously. So I just copied exactly what he was doing, and we buy data once a month from this company. What are they called? Advanced Seller Data Services or something like that. They built a business out of, they were buying notes themselves, and they had this technology where this was in the 90s. This is a while ago. They had this tech stack where they were working with all the counties, and they were figuring out the newly originated. They could identify when a property was sold if the note holder was the same, the same entity or the same person that previously owned it. That was a seller finance note. So they have figured out a way to scrape that data and then monetize it. And so we buy data from them. It's been really, really good. Scott Arpan is the guy that started that company. You can look him up online, and his website looks like it hasn't been updated since 1998, but I know he has a good business and it does well. So we get the data, and I'm doing 1,000 a month. So 1,000 mailers a month. I would like to increase that. But for right now we're doing 1,000, and we're just sending them this mailer that basically says, we see that you recently originated this note. I mean, I'm paraphrasing this, but we see you've recently originated this note on this property, and we can offer you cash up front if you prefer to have that instead of a residual stream of income, and get in touch with us if you want an offer on your note. And that's what we've been doing, and it's been pretty good. And then as far as servicing them, we're having them serviced by a third party, because especially with some of these notes, none that we've bought so far have been for primary residence borrowers. But when you're getting into that, you just want to make sure you're compliant, and you want to deal with a servicer that they know all the compliance, they know all that stuff. Let them worry about it. Pay a small fee every month. That's what we're doing.
That's amazing. That's it's interesting that you listened to a podcast and that gave you almost the golden ticket to go out and start the buying of notes. I'm sure you didn't want to give all the secrets away just there, so other people potentially don't copy and become competitors of yours. But it's just amazing how much is available out there if you do listen through podcasts. I did want to go back to something right at the beginning. And again, I'm changing gears here slightly. One of the first things you said is that you didn't like tenants, you didn't like toilets. Then you went into passive investing, and you've invested in a number of different syndications across various different asset classes. And now you're kind of more in the hard money space. Like, when you speak to investors, how do you differentiate the pros and cons of being an active investor versus being a passive investor? Because a lot of people that listen to this podcast are either looking at buying their first property or have bought their first property, or in the same boat that you were, that they don't like tenants and toilets, and now they want to go into passive investing. In my world, I didn't have the time to actually go and be an active investor, so I dived straight into being a passive investor. Like, how do you communicate the differences between active investing and passive investing to those investors that you work with?
Yeah, great question. A lot of the people I work with, it's an easy sell because they've owned properties and they know they know all the headaches that go along with owning properties, whether it's commercial or residential or whatever. There's always going to be, it's never passive. People talk about owning properties and the passive income when you own a rental property. I would say it's passive-ish, but there's nothing passive about getting a call at 3 a.m. because someone's, has a leaky pipe or a toilet, something flooded because of a toilet that is leaking or whatever. There's nothing at all passive about that. And a lot of the guys that I work with, they have experienced that themselves. So I don't really have to sell them on that at all. They know exactly where I'm coming from. And it's an easy sell when you tell them, look, there's, all you have to do is sit back. We do auto ACH. You put in your bank account info, and Lord willing, if we're able to, as we've been profitable and able to pay distributions, then you just have to sit back and collect those. And once a year, we give you a K1 for tax purposes. And aside from that, giving that to your CPA, there's really nothing that you have to do. We're the ones that are making the decisions every day and dealing with all the headaches of in our case, running a lending company. Somebody that, has an apartment building that they've syndicated, 100-unit apartment building. They're the ones that are out there, dealing with managing the property manager and all the contractors and all that stuff. So, there's a value to that I think that a lot, Chris, you said that you went right into that. You jumped right into passive investing. It's been my experience that is rare. It seems like more often than not, guys get into the active side, realize that, like I did, it's a lot of headache and they'd rather be on the passive side. So,
it wasn't for a lot of times let me tell you that. Hours and hours searching through Zillow, trying to find a property that would make sense that I could try to acquire and become an active landlord that ultimately just never panned out. Then the passive opportunities appeared and haven't looked back since.
Yeah. Well, in your case, it's the same thing. You just realize how hard it is to find a property, and it's easier to just find a good operator to place your capital with that's going to go out and do all that heavy lifting on your behalf, basically.
For sure. And Will, you've shared a ton of good information. I'd be curious to hear how you think about the business going forward with where we're at in the economic cycle, kind of where interest rates are for long-term debt. What are you trying to do in 2026 and moving forward to grow Harvey Capital? It sounds like you're just focusing on primarily these two funds. Do you invest as an LP anymore into multifamily, or is it just growing Harvey Capital with the fix and flip kind of lending business, and then the other fund that you're running as well? Can you elaborate on your outlook on the path forward?
Yeah. I for the time being, I probably won't, not because I have great guys that I've worked with in the past. I actually just had a deal that I put some money in back in 2020, and it just exited. It was a multifamily deal.
Best time.
And it was a great outcome. And, I love those deals. I think they're awesome. But for me, I want to, I really believe in what I'm doing, and I want to invest my dollars there. But also I want my LPs to see that I have skin in the game, and I put my own money into every venture that I do. And so that's really where any available cash personally will be going moving forward. So I think I missed one part of your question. What was the other part of that? Oh, the outlook on where I think everything is going. Yeah. So, we've seen a slowdown in the, like I said, I'm primarily in the Richmond area. We've seen a slowdown here. So I'm kind of watching what other guys are doing, and I'm hearing these. We just started this fund back in September. We started doing our first loan. We closed our first loan in November, so it wasn't that long ago. And so we were already in a little bit of a slower time. But the guys that have been doing this a while, they're talking about, seeing more extensions from their borrowers and more stuff that, isn't necessarily in a distressed territory where they're going to have to put the borrower in default or anything like that. But they're seeing projects take a little bit longer to sell, and I'm very cognizant of that. Recently, I lowered the amount that we would do as a percentage of ARV. So it was 75. Now it's 70. And, I really want to be comfortably in the 60s. And, our weighted average so far is, I think, in the low 60s. So we're there, and I feel pretty comfortable. We don't have anyone in default. And I think that just keeping our finger in the wind and staying up to speed on macro trends and what is going on is important. But I think the more important thing for us, or for any local lender throughout the country, is having a deep understanding of your local market or markets. So I'm constantly trying to talk to guys. Luckily, I'm interacting with borrowers all the time who are out on the front lines, if you will. And so I get to hear what's going on and hear about, how some. I have this one guy that he keeps making offers on deals in the MLS, and he can't win an offer to save his life. He's trying to buy a house to it would be his first one, and he's a great borrower, has good cash, good W-2 job, and but he just can't. Everything that he puts a bid on at full price, and sometimes even over, he gets outbid on. So some of the markets, some of the areas are crazy, and then others have slowed substantially. So that's where that local knowledge comes in. And to go back to the question of would I venture outside of our local markets, that's why you don't do that, because it really, when you're in the local market, you know everything that's going on there that someone coming from out of state isn't going to know. So I went on a little bit of a tangent there, but my point to that is that I'm trying to keep my finger in the wind, know what's going on in the market, and just be nimble and agile, so that we're in a good position from a risk standpoint.
Yeah, I think it sounds like you're doing a great job, Will, of kind of keeping your finger on the pulse there, and making sure that you're adjusting your business as needed. You've shared a ton of great content throughout this. Where can people reach out to Will Harvey if they haven't spoken to you before, if they're interested in potentially investing into one of your funds? Where can people reach you?
Yeah, they can go to my website, learn more about us and just what we do, my background, my track record. My website is harvey-capital.com. Or they can just email me, will@harvey-capital.com.
Perfect. This has been extremely helpful, Will. Thank you for joining us. Everybody go check out harvey-capital.com. We'll put that in the show notes as well, so that you can all click the link there. And for those of you who haven't yet, please do like and subscribe to the podcast. We haven't said that yet on a podcast. We got some feedback that we should say it. So there it is, the first: like and subscribe to the podcast. But Will, thank you very much for your time. Great content. Thank you.
Yeah, really appreciate you guys having
Thanks,
me
Will.
on.
Talk soon.
Yeah.